Good day, students. Once again, I will be doing the question 4 on budgets, focusing on operational budgets. This question says that Puremanzi Engineering produces a sub-assembled filter. So now this is the product used in the purification of water by the major suppliers of drinking water like municipalities, farmers, mines, and etc. And they say here are the projected sales or the estimated units to be sold for the coming 4 months, which is in the year 2011, were given as follows. We have January, February, we have March, and we have April, and these are their expected sales: 4,000, 5,000, 6,000, and 6,000 in the month of April. Then after, they say the following data or the following petition to production policies and manufacturing specification followed by Prezi Ltd. So now these are the data specifications that are being followed by this company, being an engineering company. Number one says that finished goods inventory on the 1st of January 2011 is 1,200. So now we are given the opening inventory at the beginning of January. This is opening inventory at the beginning of January for the filter, and they say each is costing 330. So now the cost for these finished goods, it was 330. Then after, it further say that the desired ending inventory for each is 40%. The desired of this inventory for each, it is 40%. So now that being 40%, therefore now we have to calculate. They say it's 40% of the next month sales. That means the closing inventory is equal to 40% of the sales of the next month. That means closing, let us say in the case of January, a closing inventory of January will be 40% of the inventory in February. So now that means the sales of February, which is 5,000, times that by 40%, will give us 2,000 as the closing of the month of January. And the closing of January becomes the opening of February. Then I'll explain that when I do the budgets as I continue with my calculations. That means now again, the closing of the month of February, once again, the closing of February is 40% of March. That means 40% of 6,000. If we say this times by 40%, 6,000, we multiply this by 40%, it will give us 2,400. Therefore now 2,400 will be closing in the month of February, and the closing of February becomes opening in the month of March. However, I will still, as I mentioned, that highlight this repeatedly along the way in doing this exercise. Therefore now they gave us the opening units and the closing units. Remember, the 330 was the cost of the opening. They just gave us the cost of the opening, which was the cost of production from production per unit from the previous period of the 1,200 units. And number two, being a very critical information, they say the data on direct material used are as follows. We have the material, which is the metal, and we have the second material, which is called components. That means for a product to be complete, or in fact for this purification of water to be complete, we need a metal and also need components. They say we need 10 kgs per unit at a price of 8 rand per kg. At the same time, we need 6 components per unit. Take note of that, 6 components per unit. So now that means we need 6 components per unit at a unit cost of 4 rand per component. That means now we need 6 components for 1 unit, and we also need 10 kgs per unit that are bought at the cost of 8 rand. So now in this case, we have two materials that are needed for 1 unit to be complete, and those 2 materials, the metals and the components, that are at different prices, 8 rand and 4 rand. and component require 6 components per unit and 10 kgs per unit of the metal for 1 unit to be complete, and this information is very crucial. Then after, it says inventory policies dictates that sufficient material should be on hand at the beginning of the month to produce 50% of that month estimated sales. So now that means at the beginning of the month to produce 50% of that month estimated sales, which means now in this case we are saying that the opening inventory, that means opening inventory is equal to 50% of the sales of that month. Remember, when we say opening inventory, we are referring to inventory in terms of the material, inventory in terms of the material. But the inventory in terms of the material should be able to produce or to cover 50% of the estimates of the sales for that month. That means now when we look at our sales and we say how much is our amount of sales, here we have the sales for the month of January, and our sales are 4,000. And remember, the 4,000 units are the units that are already completed. But now remember, under number 2, we are dealing with the material. Don't forget that. That means now in the case of the metal, I'm looking at the metal where I want to calculate, in this case, the opening inventory of the metal beginning of the year. That means we will have to say 4,000 units that the company expects to sell. We multiply that by 50%. That gives us 2,000 units that need to be sold in the month of January. However, these are the units that are needed. So for us, we need, what do we need? We need 50% of the material that will be able to manufacture the 2,000 units. So now in the case of the metal, it means in the case of the metal, we'll say 2,000 units times by 10 kgs, because we need 10 kgs of metal to produce 1 unit, which is per unit. Then we multiply by 10, that will give us 20,000. Therefore now it gives us 20,000. Therefore now 20,000 will be 20,000. It will be 20,000 kgs. 20,000 kgs of metal that are needed to manufacture 50% of the units that the business need to sell in the month of January. And that 50% is the 2,000 units that I calculated. Remember, 2,000 was 4,000 times by 50 divided by 100. That means in order for the 2,000 units, which is 50% of the units to be sold, in order for that 2,000 to be manufactured, then we need to have 20,000 kgs of metal. So now please take that into account, because we had to convert the 2,000 into kgs of metal, where we said 2,000 units, which is 50%, we multiply that by the number of kgs of metal that are needed for 1 unit. That means our opening material in terms of metal in the month of January will be 20,000 kgs of metal. This is very crucial, although in this question they did not ask us to go in that details. However, I will do this aspect, although it is not required, because it is very crucial and very important. You might be tested and you need to understand such intensive questions. Then now they further tell us that this is exactly the amount of material. Take note, the amount of material on hand on the 1st of January in the year 2001. That means it is the opening inventory, which is the beginning opening inventory. Then after, it says under number 3 that the direct labor used per unit of output is 4 hours. That means the company spends 4 hours to complete 1 unit. And it says the average direct labor cost per hour is 35 rand. That means employees are paid 35 rand per hour. That means now in this case, if we say 4 times by 35, this will give us the cost of direct labor per unit. If we say 4 by 35, this will give us 140, and 140 will be the cost of labor per unit. Cost of labor per unit. Cost of labor per unit. However, we'll do this as we continue, and we'll calculate that again. Then now under number 4, they speak of the overheads. And they say under number 4 that manufacturing overheads each month is estimated as follows based on the direct labor hours. That means our overheads are based on direct labor hours. So now that means they give us that our variable cost of overheads is 15 Rand per direct labor hour. That means if we say 15 Rand times by 4, what is 4? 4 is the number of labor hours it takes to complete 1 unit. So now that means if we say 15 by 4, that will give us our overheads cost per unit. That will be 15 times by 4. Therefore, now this will give us 60 Rand, and 60 Rand will be overhead cost per unit. Overhead cost per unit. Overhead cost per unit. However, I will still do that along the way when I do the actual budgets or when I do the budgets. Then we are also given our fixed cost in total as 200,000 rands. So now that is the total fixed overhead cost that is given in total as 200,000 rands. So now let us continue with that and we go to number 5. Number 5 says the unit selling price of the sub-assembled filter is 460. So now this is the selling price, and that selling price can help us when we calculate the sales budget. Then after they say under number 6, monthly selling and administration expenses are as or estimated as follows. We are given our variable selling and admin, which is 4 Rand per unit sold. And remember, these variable overheads, they are per unit sold. That means for every unit that we sell, we incur 4 Rand of the selling and admin expenses. Then after, we are also given fixed admin expenses as 110,000 rands. So now I will go through that. However, for number 6, we are not given the instruction to apply number 6, and also we are not given instructions to apply number 2. However, I will explain more especially number 2 because it is very crucial. So now we are given the requirements, and under the requirements they tell us what is required. They say we must prepare an operational budget per month for the first quarter, which is January, February, and the month of March. It is for 3 months period. And they say the following budgets must be done: the sales budget, production budget, direct material budget, manufacturing overhead budget. Then after, we must do production cost budget, which is the manufacturing cost per unit budget, and this must only be for the month of January only for the month of January. So now that is number E, where we are doing the production cost budget. Now if you look in this case, we are not required to do material purchases budget. We are only required to do production and direct labor. Material purchases budget is not required. However, I will do the material purchases budget at the end of this exercise so that you see that part of the material which was not required. How do we account for that? And remember, material purchases budget will be based under number, it will be based under number 2. So now I will try to do that at the end of this exercise so that we have an understanding of that. So now we start with number A. We start with number A, and number A we are doing sales budget, and this is sales budget for a 3 months period, which is January, February and March. January, Feb and March. We are doing this budget for 3 months, and we start with the expected sales. We always say expected sales. And our expected sales, they are given for the month of January, February and March. And our expected sales is 4,000, 5,000 and 6,000. 4,000, 5,000 and 6,000. So now these sales, they increase by 1,000 every month. 4,000, 5,000 and 6,000. And we multiply this by selling price per unit. We multiply this by selling price per unit. And our selling price per unit selling price per unit. We have our selling price per unit as 460 rands, if my memory still serves me. We have our selling price per unit as 460 rands. Let us just check the selling price that was given unto us. Yes, here was the unit selling price of the sub-assembly filter, 460 rand. So we always multiply by the selling price. The selling price remain constant despite the difference in months. Through all the months, the selling price was the same amount, which was 460 rands per unit. So now with that, we can multiply the units by the selling price to get to the estimated sales in value. Therefore, now it will be 4,000. We multiply that by 460, and it will give us 1,840,000 rands. 1,840,000 rands, and we say 5,000 times by 460. That will give us 2,300,000. 2,300,000, and the last month will be 6,000. Multiply that by 460. This will give us 2,760,000. 2,760,000 rands. This will be our estimated sales value. Estimated sales value. Estimated sales value. Estimated sales value. Then this is the end of this budget, and it ends here. A very, very easy budget where you can just get those marks that are given for free. So now here is the first budget, which was the sales budget, and the second budget was production budget. And production budget, we know that it also starts with the estimated sales, and here was number B, to do production budget for 3 months, January, February, March, or for the first quarter. So now we have our production budget. Just to change the color, production budget. Our production budget, it is still for 3 months, production budget. And we know that this budget starts with the estimated sales. And our estimated sales, or our expected sales, they still remain at 4,000, 5,000, and 6,000. Remember, still for the same month, January, February, and March. Hence, I don't have to rewrite these 3 months. Therefore, now from there, we start adding the closing stock. We start adding the closing stock always. We say plus closing stock because closing stock would have been produced in the current accounting period. Then we add the closing stock, and our closing stock is, there is an information that told us how to calculate the closing stock, where they told us that closing stock is 40% of the sales of the next month. They said to us that the desired ending, which is closing, that is ending, which is closing, the desired ending inventory for each month is 40% of the next month's sales. That means the sales of the following month is the closing, or 40% of the sales of the following month is the closing of the current month. 40% of the sales of the next month is the closing inventory of the current month. So now let us do that. So now we have all the sales for all their respective month, which is January, February, and March plus April. So now let us just calculate our closing. And we have our sales, and we know that the sales of the month, 40% of the sales of February is the closing of the month of January. So now that's what they are telling us, meaning 40% of 5,000, which is the next month, is the month of February, times by 40%. This will give us 2,000. Therefore, now 40% of the sales of the next month is the closing of the current month. Therefore, now that will be 2,000. Let me just change that color so that we know it comes from those calculations. So now that means here we'll have 2,000 as the closing. and 40% of the sales of the month of March is the closing of the month of February. And here are the sales of the month of March. Therefore, now 40% of that is the closing of the month of February. That means we can say 6,000. Multiply that by 40%, it will give us 2,400 as the closing of the month of February. Therefore, now we need to know the sales of the month of April, because 40% of the sales of the month of April, which is 40% of 6,000, will be the closing inventory in the month of March. So now we say out of that 6,000, we multiply that by 40%, that will give us 2,400. And 2,400 units will be the closing units in the month of March. So now that means we also have the same closing as 2,400 in the month of March, which is the same as that of April. Then after we add the two, we get to the units required. This will be 6,000. This will be 7,400. This will be 8,400. Then after, this will be units required. Units required. Therefore, now units required will be 6,000, 7,400, and 8,400. Then after, we less opening inventory, because opening inventory was already produced in the previous accounting period. Opening inventory, opening, I said closing stock. Then this is opening stock. Then our opening stock, we know that it has to be negative. And don't forget the accounting principle that closing of the month of, because here we have January. Let me just save my months here so that we are clear. Here we have January, here we have the month of February, here we have the month of March. So now we know that the closing of the month of January becomes opening of the month of Feb. So now that means 2,000 will be the opening of this month, and the closing of the month of February is the opening of the month of March, that is 2,400. Therefore, now we need to know the closing of the month of December. We need to know the closing of the month of December, so that the closing of the month of December becomes opening of the month of January. So now, can we be able to calculate the closing of the month of December? Yes, we can be able to calculate closing of the month of December. How? Is because we know that 40% of January was the closing of December. Remember, they said that 40%, they said the desired ending, which is closing inventory for each month, is 40% of the next month sales. So now that means in this case, 40% of January is the closing of December. So now meaning the closing of December is 40% of the sales of January. That means we can be able to say 4,000, we multiply that by 40%, it will give us a closing of 1,600, which is closing of the month of, which will be closing of, let us check first. If we're not given the opening, okay, it's given, we don't have to calculate it. I think there was 1,200, that was okay, yes, we already given. Here was the finished goods inventory in January, which is opening 1,200. They already gave us the opening. So now in this case, we don't have to do the recalculation. They've already given us. However, we'll still be able to calculate the opening of January, because it would have been 50% of the next month's sales, but they've given it to us as an amount of 1,200. Therefore, now our opening for the month of January, it will be 1,200. It is already given to us. When it's given, please don't worry about the calculations. However, if it wasn't given, we'll still be able to calculate that. Therefore, now it will be 6,000 less. It will be 6,000 less 1,200, and this will give us 4,800. Then we say 7,400 less 2,000, and this gives us 5,400. Then after, we'll be able to say 8,400 less 2,400, and this will give us an amount of 6,000 units. Therefore, now our production requirements will be 8,400, 5,400, and 6,000, which is our production requirement. Production required, or production requirement, is 4,800, 5,400, and 6,000 respectively for month of January, February, and March. So now we have done our production budget. Therefore, now that was number B, though I forget to write that. That is number B. Therefore, now we check what is the next budget that is required of us. The next budget that is required is our direct labor budget, which is number C, direct labor budget. Therefore, now we do the direct labor budget. In total, that is number C, direct labor budget, direct labor budget, direct labor budget. Remember, I said that I will do material later on, and our direct labor budget is for the 3 months. Once again, the month of January, the month of February, and the month of March. The month of January, the month of February, and the month of March. Remember, it is for a 3 months period, or it is for the first quarter of the year, which is January, February, and March. Then now we know that this budget starts with the production required. Production required. Production required. Always start with the production required, because these are the units that we want to produce: 4,800, 5,400, and 6,000. So now we say, okay, we want to produce 4,800, we want to produce 5,400 in the second month, and we also want to produce 6,000 units. However, how many hours does it take to produce the given units? Therefore, now we multiply that by the number of hours, which is labor hours per unit. We multiply that by labor hours per unit. Labor hours per unit, and our labor hours per unit, I think they are consistent to be foreign. They are consistent to be foreign. They are consistent to be foreign. Our direct labor cost per unit is given to be 4 hours. Our direct labor hours per unit, it is given to be 4 hours. And here is the 4 hours. Therefore, now we multiply by the labor hours per unit, which is 4, 4, and 4 throughout. 4 and 4 and 4 throughout. Then now we say 6,000 times that by 4, it will give us 24,000 hours. Then after we say 5,400 times by 4, this will give us 21,600 hours. And this will be 4,800 times that by 4, it will give us 19,200 labor hours. These are the labor hours that are required to manufacture 4,800 units. And this is the total labor hours that are required to manufacture 5,400 units. And this is 24,000 labor hours that are required to manufacture 6,000 units. So now these are the labor hours that are required to manufacture the required units. Therefore, now this will give us total labor hours, total direct labor hours, total direct labor hours, total direct labor hours. And our total direct labor hours are given as 19,200, 21,600, and 24,000. Then after we multiply that by labor rate per hour, multiply that by labor rate per hour, labor rate per hour, because our employees are paid per hour, not per product. If our employees were paid per product, therefore now we can just say the labor cost per product, we multiply that by the number of products. But in this case, our employees are paid per hour. Hence, we first have to convert our units into the number of hours that are required to produce the desired production required. So now we know that is 35 rand, it is 35 rand, and it is 35 rand. Let us check if is our labor rate per hour 35. Yes, average direct labor cost per hour is 35 rands. So now we have multiplied that by 35 rand. Therefore now we say 19,200 times by 35, and it will give us a total of 672,000 rands. 35 times by 21,600, that will give us 756,000. Then after it will be 24,000. We multiply that by 35 and it will give us 840,000. 840,000. So now this will be our labor cost, total labor cost, or estimated total labor cost. Estimated total labor cost. It will be estimated total labor cost. Estimated total labor cost, and therefore now this will be our estimated total labor cost, and this is in total. However, we can still calculate the per unit. Remember, if we want it to be per unit, we can still say 840,000, divide that by 6,000. That will give us per unit here as 140. And we could also say 756,000, divide that by 5,400. That will still give us 140. And even if we say 672,000, divide that by 4,800, it gives us 140. And the question is, why our labor cost per unit remains the same? Remember, it comes from for cost accounting 1, because our labor cost, remember, our direct labor per unit is variable. And we know that variable cost per unit, they remain the same. So now that is why our labor cost per unit is the same through all the months, because our variable cost per unit, they are constant. That means variable cost per unit are fixed. That is why we see the same amount throughout all the months, because they are fixed. There was no increase. So now this will be our labor cost per unit. However, it was not required, but just for the sake of information, for you to know that it would have been calculated like that. If you are required to calculate the labor cost per unit, it will be 140 through all the months. And now that will be the third requirement that we have answered. Then we go to number D, and number D is the requirement that requires us to do manufacturing overheads budget. Manufacturing overheads budget. That is number D, manufacturing overheads budget. And this is manufacturing overheads budget. Let me just say overheads budget. Overheads budget. Manufacturing overhead budget. Overhead budget. For 3 months, nothing has changed. Month of January, month of February, and the month of March. And we start with the number of hours. Why do we start with the number of hours? It is because our overheads are based on direct labor hours. Our factory variable overheads, which is variable cost per, is 15 rand per direct labor hour. That means we need to know the total direct labor hours, and we multiply that by 15. Then that will give us total variable overhead cost. Then after we add the fixed cost of 200,000, that will give us the per unit of our overheads. So now let us go in that same note. Then we say our total labor cost to our total labor hours. In fact, total labor hours. Our total labor hours. Our total labor hours were given to be 19,000, I think it was 19,200. Let me check that. Our total labor hours were given to be 19,200. Yes, there is total labor cost in that row. This is where we start. We don't have to start here because we will be just doing the recalculation of the same amounts. So now we just start with the 19,200, we record 21,600, then we record 24,000. So now this is where we are, 19,200 plus 21,600 and plus 24,000 hours, because our overheads are based on labor hours. Then after we multiply that by our variable overhead cost per unit, multiply that by overhead per unit, and our variable overhead per unit, we were given an amount and it was 15 rand. There is the variable overhead per unit, 15 rand. Then we multiply by 15 rand. Remember, this 15 rand is 15 rand per direct labor hour. So now that is why we multiply it on the direct labor hours, so that we get to our variable total overheads. Then after we add the fixed portion, then we get to the total overheads. That will give us total estimated variable overheads. Total estimated variable overheads. Total estimated variable overheads. And that total estimated variable overhead will be 19,200 times by 15. That will give us 288,000. That will give us 288,000. 21,600 times by 15. That will be 310. 24,000. Then we say 24,000. Multiply that by 15, and it gives us a total of 360,000 rands. 360,000 rands. So now these are the total amounts. Then from here now we can add our fixed cost plus fixed cost, fixed overhead, fixed overhead cost, and our fixed overhead cost, I think it was 200,000 throughout. It was 200,000 here was our fixed cost, which is in total 200,000, and we record that 200,000 as it is. 200,000, 200,000, and we record 200,000. Then after this will give us our total overhead cost, our total estimated overhead cost, which will be 200,000 plus 360,000. That will give us 560,000. That will be 560,000. 560,000. Then after we have 324,000 plus 200,000, and this will give us 524,000. Then after we have 288,000 plus 200,000, this will give us 488,000, and that will give us the total estimated overheads. Total estimated overhead cost. Total estimated overhead cost. So now this will be our total estimated overhead cost. However, if we wanted, we could also calculate this per unit, though obviously there will be some decimals in this one. We can say divide by the number of units, which is our number of production units. It is 4,800. 5,400. Then we can say divide by 4,800. This will give us 101. 101. That means here we'll have 101.17. Then here it will be 524,000. Divide by our production requirement of 5,000. Production requirement of 5,400. We divide that by 5,400. Then it will give us 97. Therefore, now we go there. Then we record the 97. 97.04. Then for the next month, it will be a total of 560,000. We divide that by our production requirement of 6,000. No, of 6,000, yes. Then that will be 93 rand 33 cents. 93.33. However, for this, it will vary. Why? Because we have different figures. Obviously, there's a fixed portion, then there's also a variable portion, then it has to change as the number of units changes. So this would have been per unit, overhead cost per unit. Overhead cost per unit. This would have been overhead cost per unit if this was required. So now we continue on that same note. Then after we do the next budget that is required, and the next budget that is required, it is the last budget, which is the production cost per unit budget, only for the month of January. It is required only for the month of January. Only for the month of January. Then let us do that budget. Let us do that budget. And this one is not much going to be accurate. You can just be ignorant of that because we have the fixed and the variable portion. So now let us do number E. And number E is the production cost budget. Number E is the production cost budget, which is production cost per unit budget. That means we are doing production cost per unit budget. Production cost per unit. Only it is for 1 month. And that 1 month is only the month of January. So now we know that our production cost per unit, it is made of direct material. Always know that. This could be called the manufacturing cost budget. This is direct material. And we have two materials, don't forget. The first material is metal. The second material is components. Components. So now we are only doing it for 1 month, which is the month of January. We have to go and check how many kgs are required for components or for the metal of material. We need 10 kgs per unit. And those 10 kgs are bought at 8 rand. Therefore, now we say 10 times by 8 rand. We say 10 kg times by 8 rand. Then when it comes to components, they told us that we need 6 components, and those components are bought at 4 rand. And it is 6 components per unit. So now this is also per unit. Then we say 6 times by 4. That will give us the material cost per unit. And the material cost per unit, it will be 10 times that by 8. It will give us 80 rands. Then after we say 6 that by 4, it will give us 24 rands. Then we have to add the 2, it gives us the total material, 80 plus 24. Therefore now our direct material cost per unit will be 104 rands. that will be 104 rands in the month of January, because we are only doing this for the month of January. Only for the month of January. Then after direct material, we know that the production cost is direct material. Then after it will be direct labor. It will be direct labor. And we know that our employees are working 4 hours to complete 1 unit. And those employees are being paid a specific rate. And the rate of our employees, it is given to us as 35 rand. Here the average direct labor cost per hour. And employees are working 4 hours to complete 1 unit, which is 4 hours of 1 output. Therefore, now we say 4 times by 35 to get to the direct labor cost per unit. Therefore, now we multiply that by 35. It will give us 35 rand times by 4 hours. That means our direct labor cost, it is 140. Remember that 140 we have already calculated. It was consistent, and I said the reason why is 140 throughout. It is because direct labor cost, the variable cost, and the variable cost per unit, they remain constant. Then after we add our overheads, we add our overhead. And our overhead, we had the fixed part and we had the variable part. So now we will first have to record the variable part, variable. Then we also have the fixed part. And our variable was based on labor hours. And we had our variable components, and our variable part is, there we have our variable overheads. It was 15 rand per direct labor hour. And we have to say 15 rand, multiply that by the number of labor hours, or by the number of direct labor hours it takes to produce 1 output or 1 unit. Therefore, it will be 15 rand multiplied by the direct labor hours per unit, because our variable overheads are based on direct labor hours. So now it will be 15 times by 4. 15 rand times by 4 hours. This is 4 hours. Therefore, now it will be 15 multiply that by 4, and it gives us 60 rand, which is 60 rand of the variable, or 60 rand will be the variable overhead cost per unit. Then there was a fixed portion, and fixed overheads was 200,000 per month. We divide this by the number of units that were produced in the month, or are needed to be produced in the month of January. And our production required for January is 4,800 units. These are the units that we need to produce in the month of January. So now we say our total fixed cost for the month, we divide that by 4,800 units. Then that will give us the total of 200,000. Divide by 4,800. It will be 41 rand 67 cents, just to round off to the nearest rands, or to 2 decimals, plus 60. This will give us 101.67. Though this was calculated, still it was not very much accurate because of the decimals. So now, though we did calculate that when we did the variable overhead, but it was a very close amount, not that much accurate. So now our cost per unit will be here at the bottom, which is cost per unit. And our production cost per unit will be a total of 101.67 plus 140 of direct labor plus 104 of the direct material, and this will give us 345.67. Then now we go to the last requirement, if there is a last requirement. Then we check for the last requirement. So now we have completed all that was required. However, the last part now that still needs to be done is the part where we deal with the material. Because I told you that this part, which is number 2, is very crucial. Therefore, now I will begin with that, and I will just integrate it later on for you and do that part. Thank you, guys. Thank you, student. Once again, I am still continuing with the same question, but now I'm doing part 2, which is the material part of this question, which was not required, but I highlighted that this is very important for your understanding. So now that means in the requirements, I will add one requirement here at the bottom, which will be requirement number F, and in the requirement number F, I will require that we do material purchases budget, material purchases budget for 3 months, for January, February, plus the month of March. So now we'll be doing this for 3 months, January, February, and March. And I want to do it for each material, March. And I will do this for each material, which is component and the metal, for each material which is metal and component, Then after the last one, number G, is to do the material purchases for both materials, and I am doing it for both materials only for the month of January, for January only. So now these are the 2 requirements that I have added because they are very important, though we are not required to do these requirements. So now I will start with the material purchases budget, which is number F, material purchases budget, for the first material being metal. Then that is number F, material purchases budget, and that is for metal. Take note of that. I will separate them first, then after I will combine them only for 1 month. So it will still be for the 3 months, the month of January, the month of February, and the month of March. So now when we do that for 3 months, we need to know that we have 2 materials that we have one material that we are focusing on, which is the metal materials, only for metal. So now we start with the production required. Remember, we start with the production requirement. And we know that our production requirement for the month of January are given to us as 4,800. Here are the production requirements, which is 4,800, 5,400, and 6,000 respectively. So now we say this is 4,800, 5,400. Then after the last month, which is the month of March, will be 6,000. Then what do we do now? We multiply that by kgs of metal per unit. And we know that the required kgs of metal per unit, it was given to us as 10 kgs of metals that are required per unit. Here the metal, it is 10 kgs of metal per unit. So now we multiply that by the kgs of metal per unit, which is 10 kgs, 10 kgs, and 10 kgs. Therefore now that will give us the material required. Therefore now this will be material required, of which the material required here is going to be 48,000 kgs of material. Then after, this will be 54,000 kgs of material, and this will be 60,000 kgs of material, which is the metal material. Then after, from this stage, we know that we always have to add the closing inventory or the closing stock of material. Then after, that will give us the total, which is the total material required. Then it will be equal to total material required, total material required, total material required. Then after we get to the total material required, we will have to subtract the opening stock less opening stock, because opening stock was already bought in the previous accounting period, less opening stock. And we don't need to buy material that was there in the beginning, because the material that was there in the beginning was already bought in the previous accounting period. So now, because of that reason, as I've been mentioning it to you, that opening stock must be deducted. So now that will give us the total purchases in kgs. Therefore now that will be purchases in kgs, purchases in kgs. So now this will be the purchases in kgs. So now let us check our closing, and there was an instruction in terms of how to calculate the closing, and I think also the opening. The policy said that inventory policy dictates that sufficient material should be on hand. Remember, on hand means closing. That means closing stock should be kept on hand at the beginning of, okay, that is the closing. Sufficient material should be kept on hand at the beginning, so that is the beginning, at the beginning of the month, to cover 50% of that month's sales or estimated sales. That means our inventory at the beginning of the month should be equal to 50% of the sales of that month. Remember, we are speaking of the inventory being the inventory of material, not the inventory of the finished goods. That means 50% of the sales of this month will be the material at the beginning of that period or the beginning of the month. So now in this case, we know that the sales of the month of January, remember we are doing the opening in this case, then after we will do the closing. We know that in January we have 4,000, and we know that 50% of that will be the opening material. Therefore now we have to say 4,000 times that by 50%, that will give us 2,000 units that are complete. So now we say 2,000 units. How many kgs of material will be 2,000 units? Because 2,000 units are the units that are already complete. Therefore now that is why we have to multiply that by 10. And remember, 10 is the 10 kgs of metal material per unit, so that we have enough kgs of metal, which is 20 kgs in this case. Therefore now 20,000 kgs of metal will be enough to produce the 2,000 units, which is half of the units that are expected to be sold in the month of January. So now that means our opening inventory for the month of January will be a total of 20,000. That will be 20,000 as an opening. Let me just use a different pen so that we see that. So now it means we will have our opening as 20,000, which is 20,000 kgs of material will be enough to manufacture 2,000 units that are expected to be sold in the month of January. So now we know that the opening of the month of January would have been the closing of December, but we don't need December. So now let us go to the next month, and which is the month of February. How do we calculate the opening? Because we are only given the instruction to calculate the opening, then we'll work backwards to calculate the closing of the previous month. So now once again, we need the opening of the month of February. Remember, the opening of the month of February, they said that it has to be 50% of the month of sales. They say it must be equal to the opening stock, which is at the beginning of the period, should be equal to 50% or be able to cover 50% of that month estimated sales. So now once again we'll say 50% of the sales, which is 5,000. Here is 5,000 units that we expect to sell as expected sales. We multiply that by 50% and it gives us 2,500. And you say these are the 2,500 units, which is half of the units to be sold. Then we multiply this by the kgs so that we get the number of kgs of metal material that are needed to manufacture 2,500 units. Therefore, now we multiply that by 10, it will give us 25,000 kgs of metal. That means we need at the beginning of the year to have 25,000 kgs of metal in order to produce 2,500, which is half of the units that are expected to be sold in the month of February. That means the opening of February will be 25,000. Opening of February will be 25,000. So now remember, opening means it was the closing in the previous period. So now let us continue. I will explain that as we continue. Again, now we are looking for the opening of the month of March. And we know that the policy says inventory policy dictates that sufficient material should be kept on hand at the beginning. Kept on hand at the beginning of the month. That means opening inventory at the beginning of the month to produce 50% of that month estimated sales. So now once again we need 50% of the sales of March. Therefore now we convert that into kgs. That becomes the opening material for metal that is needed for the month of March. So now we say 6,000, we multiply that by 50%. 6,000 times by 50%, it will give us 50% of these units, which is 3,000. But we need to know how many kgs of the metal material are needed to manufacture the 50% of the estimated sales. Therefore, now we multiply by the number of kgs of metal that are needed per unit. Then we multiply that by 10 and it will give us 30,000 kgs. Remember, the 10 is the 10 kgs of metal because we want to know how many kgs of metal that are needed to manufacture 3,000 units. That will be 30,000 kgs of metal that are needed to manufacture the 3,000 units, which is half of the units that are expected to be sold by the end of the month of March. So now that means we'll have 30,000 here under the month of March, 30,000. And remember, this is an opening inventory. So now in this case, if this is the opening for the month of January, that means it was the closing of December and we don't do the budget for December. Therefore, now we will have to ignore that. And secondly, we have the closing of the month of February. Sorry, the opening of the month of February. And the opening of the month of February was the closing in the month of January. That means this closing becomes the opening of the previous month. Therefore, now this will be 25,000 kgs of metal material. Then after we go to the next month and we say the opening of the month of March was the closing of the month of February. That is why now we keep the same 30,000 kgs of metal as the closing, which became the opening in the month of March. So now we need to know the closing of the month of March. That means for us to know the closing of the month of March, we need to know the opening of the month of April. And how do we calculate the opening of the month of April first? We know that to calculate the opening, we need 50% of the material for the month of April. So now let us go and check the sales for the month of April. And here are the sales of the month of April. And we know that 50% is the 6,000 times by 50%. And 50% of that, it is 3,000. Therefore, now if it's 3,000, we have to multiply that by the kgs for the month of, for the material called metal. We multiply that by 10 and this will give us the total of 30,000 kgs. So now these are the kgs of metal that are needed in the beginning of the month of April in order to manufacture 3,000 units, which is half of the units that are expected to be sold in the month of April. Remember, if this is the opening in the month of April, therefore now this was supposed to be the closing in the month of March. So now remember, closing of the next opening of the next month is the closing of the previous month. That is why here we still have 30,000 kgs for the material called metal by the end of the month of March. So now let us do that. Then we say now we calculate first the 48,000, where now we have to say this minus this, we get here to the total. Therefore now we say 48,000 minus 25,000 minus 25,000, this will give us 23,000 kgs, which is total material required. Then after we say 54,000 minus 30,000, and this will give us 24,000 kgs. Then after we say 60,000 sorry, that is not minus, it's a plus. Sorry for that. We closing is added, not subtracted. Thank you for that recognition. We add our closing, we don't subtract. This is 30,000 and this is 30,000. We add our closing, don't forget that 30,000. So this is not right, this is not right. 25,000 is right, we add. So now we say 48,000 plus 25,000, that will give us 73,000. Then after we have 54,000 plus 30,000, that will give us 84,000 kgs. Then after we have 60,000 plus 30,000, that will give us 90,000. So now that will be the total material required. Then you say 90,000 less 30,000, and this will give us 60,000. Then after we say 84,000, we less 25,000, this will give us 59,000 material to be purchased. Then we have 73,000, we minus 20,000, and this will give us 53,000 kgs of material that are needed to be purchased. Then after we multiply this by the cost per unit, then we go and check how much the cost of this material per unit. How much do we buy this for? And I think it was 8 rand, and it will be 8 rand throughout. The metal material is bought at the cost of 8 rand. And here was the 8 rand. The metal component, metal material is 8 rand per kg. So now we multiply that by the 8 rand per kg throughout. Therefore now that will be 53,000 kgs of metal times that by 8, and it will give us 424,000. Then after we say 59,000, we multiply that by 8, and it will give us 472,000. Then after we say 60,000 kgs times that by 8, it will give us 480,000. So now these are the material that are estimated to be purchased, which is purchases in rands. This is purchases in rands. Purchases in rand. So now this is the purchases or the material that will be estimated to be bought. Let me just check the per unit only for the month of January. This is 48,000. Therefore, it will be 424,000 divided by 48,000. That will give us 8 rand 83 cents. Let me keep that in my mind. That is only for the month of January. So now we have done the material purchases only for the metal material, only for one material. Therefore now I am doing another budget for another material purchase budget only for the component material. So now I want to do them separate so that you get more clarity. That was the second part of number F. Therefore, now I think it was number F. Yes, number F. Then we do again material purchases budget. Material purchases budget. Material purchases budget. And this is also for 3 months, the month of January, the month of February, and also for the month of March, which is for the full quarter, month of March. Remember, this is for the component material. This is for the component material, and we know that we start with the production requirement. We start with the production requirement, or production required, or production requirement. And our production requirement, we know that it is 48,000, because we need to produce. Where the production requirement coming from? Production requirement comes from the production budget. It comes from the production budget. In the production budget, there we got to our production requirement, which is 4,800, 5,400, and 6,000. These are the production requirement. So now it's not 48,000, it's 4,800. So let me just recalculate this. It was 424,000 divided by 4,800, that is 88 rand. So now it is 4,800, not 48,000. 4,800, 5,400, and this is 6,000 respectively. Then after we multiply by component per unit. In this case, these are the units that are needed to be produced. And for each unit, we need 6 components. So now we have to multiply by 6 by 6 by 6. In this case, for each unit, it requires 6 components. And that was stated to us components, 6 components per unit. And those components are sold at or are bought at 4 rand. So now we multiply by the components per unit, and that will give us material required. That will give us material required. That will give us material required, where we multiply by the component per unit. We multiply by the component per unit. Then we say 4,800 times this by 6. It will give us 28,800. Let me just check something if I have. Okay, that will be 48,000. That is right. I just wanted to confirm that I did not say 48,000. Then after we have 28,800 material of component that are required, and 5,400 times that by 6, it will be 32,400 components that are required. And we say 6,000 times that by 6, it will give us 36,000 components that are required, for the total of 4,800 and 5.4 and 6,000 production requirements. Then after we say plus closing, don't forget, plus closing stock, the principle still applies. Then after we draw a line here, then this will give us total material required. Total material required. Total material required, which is material that is required in total for production. Then after we subtract now the one that we already have. Then after that we have to say less opening material, less opening stock. And we know that our opening stock is less, which means always in brackets, less opening stock. Then this will give us material purchases in components. Material purchases, which is purchases in kgs, in fact, purchases in components. This is not in kgs. Then after we multiply by components cost per unit, which is cost per unit. which is cost of the component per unit. It is 4 rand, it is 4 rand, and it is 4 rand. So now we first have to check if, do we have the closing stock? Can we calculate the closing stock? And the question is, we cannot be able to calculate the closing stock because we first need to know the opening stock, so that we are using the opening stock to calculate the closing stock. So now they said again, inventory policy dictates that sufficient material should be on hand at the beginning. So now that is on hand at the beginning of the month to produce 50% of that month's sales. That means we need to have components which is able to cover 50% of the units that we expect to sell. We need to have the components at the beginning of the period that will be able to cover 50% of the units that we expect to sell in that month. That is what this statement simply means. In this case, we have in the month of January 4,000. That means we have to say 4,000 times this by 50%. And if we multiply this by 50%, it will give us the half of the units that need to be sold. Therefore now, which means it will be 4,000. We multiply this by 50% and it gives us 2,000 units. So now these are the units that need to be sold. However, we need to know how many components do we need in order to complete the total of the 2,000 units. For each, remember, for each unit, it requires 6 components. So now that's why we have to multiply by 6 components. And when you multiply by 6 components, this will give us 12,000 units. That means we need to have 12,000 components. That means we need 12,000 components in the beginning of the month of January in order for us to manufacture the 2,000 units, which is half of the units that are needed to be sold in the month of January. So now that is why we record the 12,000 here as an opening in the month of January. We record 12,000 as an opening in the month of January. So now remember, the opening of January was the closing of December, but we are not doing budget for December. Therefore now we can just ignore that. So now we need to know the opening of February, so that opening of February can be the closing of the month of January. So now we need to know the opening of the next month, so that opening of the next month become the closing of the previous month. That is why now we first skip this part where we first have to identify how much is the opening of the month of February. Therefore now opening of this month will become the closing of the previous month, because whatever you open with is what you closed with in the previous period. So now we go and check the opening of the month of February. And to say in the month of February, we need to calculate 50% of that. 50% of the month of February need to be calculated. We need to calculate 50% of that. Then after we multiply by the number of components, because we are looking for the opening material, not the opening units. So now in the month of February, we have 5,000. And if that gets to be multiplied by 50%, it will give us 2,500 units. So now these are the half units that are needed to be sold in the month of February. However, we want to know the number of components in total, which is our components times that by 6. Therefore, it will be 2,500, multiply that by 6. It will give us 15,000 components. This is 15,000 components. That means we need 15,000 components in order to manufacture 2,500 units. And the 2,500 units, it is half of the units that are needed to be sold in the month of February, or it is half of the expected sales or estimated sales for the month of February. That means now our opening stock in terms of components for the month of February will be 15,000 components. So now we go to the month of March, and we know that the opening of the month of March is the closing of the month of the opening of the month of February is the closing of the month of January. So now we go to the month of March again, and you say in the month of March, the same principle, guys, will apply. We need 50% of this, and you say 50% of the month of March. Here is March, 6,000. We multiply this by 50%, and it will give us 3,000 units. And 3,000 units, remember, 3,000 units is 50%, which is 50% of the estimated sales for that month, which is the month of, in this case, March. So now we have 3,000, and we say we need to know how many components must be in the beginning in order to cover 50%. And you multiply this by the components, then it will give us a number of components, which is 3,000 times this by 6. It will give us 18,000 components. This is 18,000 components that are needed in the beginning of the month of March in order to cover for the half of 50% of the estimated sales of the month of March. Therefore, now it will be 18,000, which is 18,000 here in the month of March. Remember now, in this case, similarly with the month of April. Month of April, we have our sales being 6,000. Therefore, now this will give us the same amount, 6,000 times that by 50%. It will give us 3,000, and 3,000 times by 6 will be 18,000 components that are required to be there in the beginning of the period. So now that means this will go here as 15,000 closing, and this will go here as 18,000. And we know that the opening of the month of April, which is 18,000, would have been the closing in the month of March. So now it will also be 18,000 components that are needed. So now with that, we can take the totals now, where we say 18,000 plus 36,000, and this will give us 54,000. Then we say 32,400 plus 18,000, and this will give us 50,400. Then after we say 28,800 plus 15,000, and this will give us 43,800. So now these are the total material required, which is total component that are required. Then you say 43,800 minus 12,000, and this will give us 31,800 components that are needed to be purchased, or that are required to be purchased. And we say 50,400 minus 15,000, 50,400 minus 15,000, this will be 35,400. And then after we say 54,000 minus 18,000, and this will give us 36,000 of the components that are needed to be purchased. Let me just do the recalculation. 4,800 times by 6, then that will be plus 15,000. Then 43,800 minus 12,000, just to make sure that my calculations are correct. We have 5,400 times this by 6, 32,400 plus 18,000. Then 5,400 minus 15,000, then this will be 35,400. The last one is 6,000 times this by 6, 36,000 minus, or first plus 18,000 is 84,000. It will be 6,000 times by 6, 36,000 plus 18,000 is 54,000 less 18,000. It will be 36,000. So everything is correct. Then now we can multiply by the component cost per unit, and the component cost per unit, it is 4 rand. Here the component per unit, it is 4 rand the cost. Therefore now we multiply with that, then we get to the total of the purchases in rands. This will be the purchases in rand. Therefore now it will be 36,000 times that by 4, which will give us 144,000, which will give us 144,000. Then after we say 35,400 times this by 4, then it will give us 141,600. Then we say after 31,800 times this by 4, it gives us 120,000. 27,200 rands. So now with this being said, that means now we have done our purchases in units or in components. Then we have also done it in rand. We have also done it in rand. So now I have covered the aspect that was very critical, and let me just do the cost here per unit only for the month of January for this component, which is 127,200 divide by production of 4,800. This will be 26 rand 50 cents. Don't write this, I just want to check some calculations. And also here for the month of January, I want to check how much was it. We said it was 424,000 divided by 4,800, and this was 88 rand 33 cents. Just want to say plus 26 rand 50, 26 rand 50, and this is 114.83, but it's fine. I was just checking something, ignore that calculation. Just wanted to check the cost of these components, how much would it be only for 1 month. So now I am doing the last part now, and in the last part I have mentioned to you that I will be doing the material cost, the material purchases only for 1 month, which is the month of January. This is number G, where I'm doing the material purchases, which is material purchases for both material budget for both materials for the month only for January. So now I'm doing material purchases only for January for both components combined. So now that is what I'm busy with now. I'm doing the material purchases for both components combined, which is the last part now that I'm doing in this question. So now we are doing material purchases budget, material purchases budget, material purchases budget, budget only for the month of January. Therefore now I must write both components because I need both components. So now for both components it will be metal and components. For both materials only for 1 month. For both materials only for 1 month, which is the month of January. So now it means we start with the production requirement. Production required. Our production requirement is 4,800. 4,800. And 4,800. It has not changed, it's still 4,800. So now I am doing this for 1 month for both components. I want to show you guys all the dimensions, how this question can be asked. So now in the previous one, remember, I have done the material purchases budget only for one component for 3 months. And here I have done the material purchases budget for one material, which is metal, for 3 months. And here I've done it for one material, which is component, for 3 months. And here now I am only doing it for 1 month, which is the month of January, which is the month of January for both components. Then after we multiply by this by, in the case of the metal, we multiply by components, or it will be kgs, and components per unit, because there is 2 of them. Therefore now we multiply by kgs and components per unit. In the case of the metal, we need, what do we need in the case of the metal? We need only 10, and here we need 6. Now we do them parallel. I want to show you that you can be required to do this question in different ways. So now this will give us material required. We have done this already, but I'm just doing it in a different approach. Material required, it will be 48,000, and here it will be 4,800 times by 6, which is 28,800. So now if you are required to do them only for 1 month, then after we will have to say plus closing material, which is closing stock. And we have already calculated the closing for the month of January. And closing for the month of January with regard to metal, closing for the month of January with regard to metal was 25,000. So we take that 25,000 as I did explain to you. 25,000, then we record that 25,000 is only for the month of January. 25,000. And closing with regard to component, our closing with regard to component for the month of January, it was 15,000. Here the closing, 15,000. So now we record that 15,000 as it is, 15,000. Then after we add the two, and adding the two, that will give us total material required, 28,800 plus 15,000. This will give us 43,800. Therefore now after we say 48,000 plus 25,000, this will give us 73,000 metal, that kgs of metal that are needed. This will be total material purchases, total material required, not purchases, total material required. Then our total material required will be all these units. Then after we say less opening stock, and we go and check our opening stock for the metal in the month of January. Our opening stock, it was 20,000. Yes, opening stock 20,000 is the opening in the month of January. Therefore now we say less 20,000. Then after, in the next part, we say less the opening in the month of January for the component, and here it was 12,000. So now here's 12,000 where I'm ticking. Then we record that 12,000 for the components. And we have recorded that for the components as 12,000. Then we draw a line. Then after drawing a line, that will give us purchases in kgs and components. Purchases in kgs/components. Then for the kgs, it will be 73,000 less 20,000. That will give us 53,000. And this would have been 43,800 minus 12,000. This would have been 31,800. Then after we multiply this by cost per unit, and our cost per unit, it is 8 rand here and it is 4 rand here. So now we multiply by the different prices. I think it was 8 rand and 4 rand for the metal and 4 rand for the components. Let me just reconfirm that. Yes, 8 rand for the metal, and for the components it is 4 rand. So now that is why we multiply by the different costs. Then after that will give us purchases in rands. Purchases in rand. Therefore now I have calculated the purchases in rand. That means we can say 31,800, we multiply that by 4, it will give us 127,200. Then after we say 53,000 metals times that by 8, that will give us 424,000 as in the total of our material. Then if we add the two now, where we say 424 plus 127,200, that will give us the total material, and our total material will be 510. It will be 551,200. Then if we divide this by 4,800, that will give us per unit, divide by 4,800, and it will still give us that 114 rand 83 cents. However, that is just my calculation just to confirm some things. Therefore, now we have done all this, and very importantly, I was doing this so that you can get to understand the importance of the information that was given here in the beginning, which is the information that was given under number 2. That is why now I have to do that, because this information was very important, but they just did not require you to do anything, and it's very crucial because you can be asked this part where now you are to do the material purchases budget. So now either way it will be asked, you'll still manage to do the calculations, because I've done it in different ways. Where in the first one, which is in the case of the metal, I did the material purchases budget only for the metal for 3 months. Then after, I did the material purchases budget only for the components for 3 months. Then after, I did the material purchases budget only for 1 month for both materials, which is material A and material B. So now this is what we come up with. So now guys, I hope this will enhance your understanding. Thank you.